Hello fellow investors, this is the Conservative Trader. You can find my website at theconservativetrader.blogspot.com. As you can see, there's a quick preview of the site on my screen. Just to mention the site a little, this week I put some stock mentions up, and you're quite welcome to read this. You find my URL at the bottom of the YouTube video, along with Twitter website. Today I'd like to talk about risk control and money management. They are very important, and capital preservation is far more important than making money in the stock market. The best way I can talk about this is by means of demonstration using stock recommendations I've made in the past on my website. You might recall I spoke about breakouts, and I'd like to look at breakouts again from the point of view of money management and risk control. People invest in stocks because they think a stock is going to go up, and they feel that if they put a lot of money in the stock and it goes up, they'll make a lot of money. And they think that there's no point in putting a little money because you only make a little money. Well, that's not the way you should look at it, because when you put a lot of money in a stock, you get nervous, you don't sleep at night, and you're very quick to pull the trigger and get out. If the stock goes up, you make 10%, you get out and you think you've done well. If the stock goes down, you stay with it. You might lose 10%, 20%, 50%, you might be in that stock forever if it never goes up again. The approach to take with risk control in the stock market and money management is to always make sure your losses are very small. If I can take this example of Cirrus Logic, symbol SCRUS, you notice at the end of March, where my cursor is pointing, there was a breakout in this stock, and then a very small consolidation. We spoke about this a little in my last video, and that's called a flag. When you see this flag and you decide to buy the stock, let's say the stock is at 836 on this chart, and you notice at the bottom of the flagpole where the consolidation is, it was 788. You should put your stop at 788 or a little below that, and typically if the stock was to go down, that's a 5 to 10% loss, and you should accept that loss, get out and move on. There are never any guarantees in the stock market. However, if the stock starts going up, as it has done here, your primary concern is that you must raise the stop at this point. Let's say you bought it at 784. Let's say you bought it at, I don't know, 847, and your stop was at 744. As the stock starts moving up, you raise your stop up to your purchase price. So now you're in this stock for free, and any subsequent rises in the stock, you can be raising your sell stop price as the stock moves up. If the stock goes down, you get sold out and you've made a nice profit. You see the pullback here in this particular stock. Let's say you got stopped out at 1150. You purchased at, I don't know, let's say 850. So you can see there's about a 30 or 40% profit there. The point is, the potential loss has to be small. Let's say it's 10%. As soon as that stock starts moving up, your aim is to raise that stop up to 0% loss. After that, you're in for free. Now once you're in for free, you can consider buying another stock, and a third stock, and a fourth stock, and as each of these stocks go up to their break-even point, you can afford to buy more stocks again. The point is, you only ever want to have a small amount of money at risk, and if you buy one or two stocks with a potential maximum 5 or 10% loss, then you're really never going to lose much money. As those stocks move up to break even and the stocks start going up, you raise your stops with it and you're only ever in profit. Let's just assume you only purchased one stock, and let's assume that you are lucky enough for that stock to go up 50%. Think about it. If you buy 5 other stocks and you put a 5% stop loss on each of those stocks, you're really only playing with the house money, and if every one of those stocks were to fail, you lose 10% on each of the 5, which is 50%. That's the 50% you made on your first stock. Let's assume you don't lose that money. Let's assume you made some good picks. You've got 5 stocks, and if those 5 stocks all go up by 50%, now you can buy 25 stocks with a 10% stop. And each time you're using the house money, you're never risking your own money. Your own money is only ever risked on that first purchase. So the approach should be to buy a stock when the stock market is looking like it's breaking out. You look for the stock that's also breaking out. You make your first initial purchase of just 1 or 2 stocks with your 10% stop loss. As soon as those stocks move up, you raise your stop so you're at break even. You can now afford to buy another 1 or 2 stocks. And as each of these stocks become profitable, you can use all or part of that profit to take in new positions. In no time at all, if the stock market continues to perform well, each of those stocks are going up, and the number of stocks you're owning are increasing exponentially. Like I said, if you've got a 50% gain, that stock goes from 1 stock to 5 stocks. Those 5 stocks, if they go up with a 50% gain, you've now got 25 stocks. Of course, this is the ideal world, and your stocks are not going to go up 50%. But the point I want to make is you want to break even as soon as possible to avoid any losses. Always use the house money to invest in the stock market. There is never a sure bet when you buy stocks. Happy trading, traders, and I'll talk to you again. Bye.